And you guys did these already on your paper, right?
I tried.
Maybe. Okay.
I really did.
So hopefully we can make it through. Quick study 23-13. Based on the predicted production of 24,000 units, the company anticipates 300,000 of fixed costs and 246,000 of variable costs. If the company actually produces 20,000 units, what are the flexible budget amounts of fixed and variable costs? So what do we start with? If we are trying to find the flexible budget amounts of the fixed and variable costs, what are we going to start with first? Did you have fixed costs? What were your fixed costs? $300,000. And what about variable?
246,000.
And what else? Yep, they predicted how many units?
24,000.
24,000. So if our variable costs we got, what was it, 246? You would need to divide that by the 24,000 units, right? Which is going to equal what?
$10.25.
Say it again.
10.25.
10, 425? 10,425?
Is that 246,000?
Yeah, divided by 24,000.
That's 10.25.
10.25.
$10.25.
Oh, yeah.
Okay, so $10.25 per unit. That's the variable cost per unit. Multiply that by how many units? 24? 20,000, which gives us what?
205,000.
Okay. And then what else do we need to be concerned with? Is that all? Do you have any other numbers to deal with? That's it.
Shoot.
So total flexible budget is going to be what? $505,000.
So that's what it is.
Okay. Quick study 23-14. Moving along. Broderick Company expects to produce 20,000 units for the year ending December 31st. A flexible budget for 20,000 units of production reflects sales of 400,000, variable costs of 80,000, and fixed costs of 150,000. If the company instead produces and sells 26,000 units for the year, calculate the expected level of income from operations. So the flexible budget is basically the 20,000 units, right? And the first thing we probably need to do is calculate what? I hear you speaking, Mr. Adhikari, I just don't hear it loud. Sales what?
That you can find the price per units.
Sales price per unit. So with the sales price per unit, what are we gonna use?
Divide by 20,000.
Which gives us what?
20.
$20?
Yes.
Okay, and the next thing for us to do is what?
Find the variable cost per unit.
Find a variable cost per unit, which we're gonna take what?
You're gonna take 80,000.
80,000 units
Divide by 20,000.
divided by 20,000 gives us what per $40? $40?
$4.
$4. Variable price per unit. All right. So now that we have the price per unit, sales price and variable cost per unit, what do we do to find the production level? What do we do?
We're gonna find the sales level.
Find sales first. And how many units are we selling?
26,000.
So sales, 26,000 units times what price? $20, which gives us what?
520,000.
520,000. What's the next thing to find out?
Variable cost.
Variable cost for those 26,000 units. $26,000 times what price? $4, which equals 104,000. And contribution margin, which is subtracting variable costs from sales. Which is how much?
416,000.
16?
Yes.
All right. So also we need to incorporate what cost?
Fixed cost.
Fixed costs. We need to subtract those as well, right? How much were the fixed costs?
160,000.
All right. What do we have here? Yeah, what's the amount?
166.
Even?
Yes.
Income from operations. Okay, good. Quick study 23-15. Refer to information in quick study 23-14. Assume that actual sales are 480,000, actual variable costs for the year are 112,000, and actual fixed costs for the year are 145,000. Prepare a flexible budget performance report for the year. So you know when we do the performance report, we're looking at what?
Looking for actual and standard and variance.
All right. Okay. I'm going to keep this here. This column will be what? Flexible or actual?
Part-time or tax.
Flexible, right? Because it was based on and then we need our actual column. I'm sorry. Just took my carpet. Need some room. All right. Actual and then difference for variance. All right, so the actual sales are going to be what?
This question, we're gonna use, this, on 14, it says, 26,000, which one? I don't know if you're gonna,
You confusing me.
no, I just asked you a question.
No, I'm asking. You confusing me because I don't know what the question is. What's the
Yeah,
question?
no, my question is, we're gonna use,
Oh, the information from 14?
yes,
Yeah. You're using the information from 14 as well as the information that's in 15. So the information that's actually in 15 is your actual amounts going down. Same thing. That's why I didn't erase that. I just copied it over. Ms. Sedgwick just said the actual amount was what, 480? What about variable costs? That means the contribution margin is going to be what now? 360? 368. Okay, and what was our fixed cost? 145, which means that our income, actual income from operations. Say it again.
223.
All right, so variance between the two, going all the way down, 480,000 from 520,000 is how much of a variance? 40,000, 112,000. Bless you, whoever that was, from 104,000.
98.
98,000. No.
Yeah, no. Oh, good.
please, my question was, we don't use, the amount they give us as, standard, 14, when they give us, that was my question.
We're using that stuff.
Because what I did, instead of using what the answer I found of 14, I went back, to use, standard, because I bought that 400,000.
Why don't we use those?
We don't use those one.
No, tell me why don't we?
Because why I use those one, I thought that the variable cost and the,
Okay, this is the best way to explain it. In 14, they asked you to calculate expected level. But when we got down to 15, they wanted you to assume that what was actually expected will remain expected, not standard at all. They want you to basically look at what you calculated for expected to prepare a flexible budget, because we know we can't use standard costs for a flexible budget performance report. Is what I'm trying to say. What is is the variance for the contribution margin?
48,000,
What about for fixed costs?
5,000,
Fixed costs,
5,000.
5,000, which means that income from operations variance is. Now, going back down the line, that 40,000 for sales, is it favorable or unfavorable?
Oh, shoot.
I know y'all hate it, but
Ah,
we gotta keep going through it. Unfavorable. What about variable expenses?
Favorable.
Why unfavorable?
because the actual is higher than the projection.
Right. What about the contribution margin?
It's gonna be unfavorable, because it's less.
The actual is less than what was budgeted. I know.
That's favorable, right?
I know you hate it. What about fixed costs? Favorable and income from operations.
Unfavorable.
Unfavorable.
It's unfavorable.
Why?
Because the actual is lower than the projection is more than.
Yeah, plus.
Okay, good. Quick study 23-16. Tersa reports the following on one of its products. Compute the direct materials price and quantity variances. You have the information there. What is the first thing that we need to do? Because you're doing two different variances. One is price and one is quantity, right? So what is this, 16?
Yes.
All right, starting with the price variance. How are we going to calculate direct materials price variance? What do we start with?
4 times 7.
We gotta find out the unit price for, that's what that is.
First, let's start with, because you know you have to go in the order, but what was the actual cost of those direct materials?
535.
And in addition to those the actual costs, next we have to also find out what that goes back to those little grids in the chapter when we're looking at direct materials price variance. What do we do next? What's next? In your chapter, let's find it for you. Looking on page 956, or whatever page you find it on, doesn't matter. And actually, we could probably look at 957. Actual quantity times what?
Actual price.
Actual price.
No. Standard price, the one in the middle. Actual quantity times standard price. How much was your actual quantity?
60,000.
The quantity you use is
Direct material.
3,000.
300,000 pounds. What did I get? What was that number?
I don't know. Where they get it on?
I heard 360 and something else. Okay, So 300,000 times what price? Standard price?
Standard
$8.
price,
$2.
Oh,
$8 is for the what?
finish.
Finish. So actual quantity
600,000.
times standard price. Three hundred thousand units times $2 gives us what amount?
600,000.
All right. Yes, ma'am.
So, because it says it's 4 pounds at $2 per pound.
We ain't got that's the quantity variance. We haven't gotten down there. We're just looking at the price right now. The price variance is taking actual quantity and it says their actual direct materials used 300,000. That's what we have to use. Times the standard price.
Okay.
And then of course we need to subtract these two. Which is gonna give us what?
65.
65,000 favorable or unfavorable.
It's going to favor because the actual is less than okay.
What'd you say it was?
I said it's favorable.
Does everybody agree?
Yeah.
Or you just not gonna say nothing because we trust that he's right. And that's okay too. You must have confidence in your classmates. All right, what about the second part? Now we're doing quantity variance. Now when you do quantity variance, what is the first thing that you need to address? Actual quantity used times standard, which we already know is how much?
600,000.
AQ times standard price, 600,000. And then what about, what's next? What do we also include? Standard quantity times standard price. Now, this is where, Ms. Harris, actual finished units produced were those 60,000 units, right? You follow me? And we're gonna multiply that by what?
By 4.
4 pounds. Standard quantity times standard, what was the other one, price? What was it? Standard quantity times standard price? Yeah. 60,000 units times 4 pounds times what? $2. Gives us what?
48. 480,000.
Okay. Subtract the 2.
So another 20,000.
22.
120.
20,000. Variance. Favorable or unfavorable? One person says unfavorable. Does everybody else say the same? Or you just won't say anything? Unfavorable. Why?
Because if we take the standard is less than the actual or flexible. If you compare 40
Standard is less than
something,
actual. All right, moving along, quick study 23-17. (23-17). The following information describes the company's usage of direct labor in a recent period. Compute the direct labor rate and efficiency variances for the period. What do we do first? Rate variance and then efficiency variance. So with the rate variance, what are we concerned about first?
actual,
Actual what?
actually for
Yeah, I know that, but what's the equation? Actual what times what?
actual times actual
Hey,
actual rate
Actual labor hours,
times actual
actual rate per hour. So looking at this, we're looking at 65,000 times what?
15.
$15. So actual labor hours times actual rate, 65,000 times $15 gives us what?
975,000.
And next we're concerned about what?
We have actual hours.
Actual hours times standard rate per hour.
That's what I know.
65,000 times what amount per hour?
14.
14, which gives us what?
91,000.
91,000?
Yes.
91,000?
Yes.
910.
Sorry.
I was gonna say.
900.
Now I know I can count. And if 65,000 times 15 is 975, how on earth is 65,000 times 14 91,000? Okay, subtracting these two, what's the variance here?
65.
Favorable or unfavorable? Unfavorable. Okay, next one, doing efficiency. What am I concerned about?
We already find the 900,000, 910,000.
Uh-huh.
We're gonna find the standard cost, standard.
So what you're saying is we already have actual hours times standard rate
Yes.
of the 910,000, right?
Yes.
And
Right now we're gonna use the standard hours times standard rate.
standard hours times standard rate, 65, no, what's the standard hours?
67,000.
67,000 times 14. How much?
932,000.
Subtract. What's the variance? Favorable or unfavorable?
Favorable.
Everybody agree?
Yeah, favorable.
Are you just saying that?
No,
I thought so too.
no,
You don't put that part in
I don't
parentheses?
say that. I analyze myself.
That's what you're talking about?
Answer the bottom, I was like,
Here?
28,000, yes.
Mm-mm.
No?
You don't have to.
Okay.
You can if you want to, but you don't have to. Okay, good. Look at how we're doing on time. All right, I think we can get through 4 more problems. 23-18. Fogel Company expects to produce 116,000 units for the year. The company's flexible budget for 116,000 units of production shows variable overhead costs of 162,400 and fixed overhead costs of 124,000 for the year. The company incurred actual overhead costs of 262,800 while producing 110,000 units. Compute the controllable overhead variance. So, what do we start off with? Okay, what do I start off with? What was your actual overhead? Because if you're looking for the overhead variance, you start off with actual overhead, which was how much? Incurred. Incurred, how much?
262, 800.
Okay, and what should you be concerned with now? Uh-huh. And we're gonna subtract that out. But how are we gonna find it? Because they didn't just give it to you. So what do you have to do?
You gotta find a variable cost.
Variable overhead, right? And the only way that you're gonna be able to do that is to find out what else? The variable overhead rate per unit, right?
Yes.
How are we gonna find out the variable overhead rate per unit? What were the variable costs that they gave you?
They give us fixed overhead cost.
No, but they also gave you the variable overhead costs. How much were there those?
152.
162,400, right? And how many units do you expect to complete?
116.
116,000 units. So calculate that for me and tell me what the amount is. So $1.40. All right, so that is our what?
Variable cost per unit.
Per unit, variable overhead rate per unit. Now you have to take this per unit and do what? Multiply by what?
110.
you take your, what is your 110,000?
This is the actual production.
Okay, so we're gonna take our 110,000, multiply that by, $1.40. What's the amount? 154,000. And then what else needs to also be subtracted?
Fixed costs.
Fixed costs. How much were they? How much?
124.
All right. Subtract. You tell me what we're left with.
It's 15,000.
16,000.
Yeah. Don't make me pull up this calculator.
I got 1,500, 15,200.
What was the amount? 262,
16,200.
800 minus 154. I'm gonna find out for myself because y'all just love calling out numbers.
Yeah.
Why is it doing that? What was the other amount? 15,200. Favorable or unfavorable? Favorable or unfavorable?
It's going to be favorable because we're talking about the costs.
Why do we say favorable?
Because if you add those two together, you're going to get 278.
These two, right?
Yeah, 278.
All right.
And
23-19. Because it's the same kind of scenario. 23-19. Aero Pro Corp reports the following for November. Compute the controllable overhead variance for November. What was the actual incurred?
28,175.
28,175. What about variable overhead costs? What's our variable overhead cost per unit? Variable overhead rate per unit.
$3.10.
$3.10. So multiply that by how many
12,000.
units? How many units? 9,800 units times $3.10. How much is it?
You got 3,380.
3,380.
Yes.
30,000 or 3,000?
30,000.
30,380.
30,000.
Fixed cost,
Fees cost are used 12,000.
uh-huh,
I don't know if it's right or not.
it is.
Okay.
So, sorry, y'all. All right, subtract the 2, what do you come out with?
14.
88,000.
Go ahead, pull up this calculator again.
14,205.
Favorable or unfavorable?
Favorable. Processing cost. It's less than actual.
Alright. Look at the time. 6:40. Alright, quick study 23-20, last one.
We don't do, I think they asked you, okay.
Huh?
No, I'm working.
Alright, 23-20. Refer to quick study 23-19, compute the overhead volume variance for November. So what are we gonna use to calculate for November? This is more so of a volume variance, so that means you have to do what?
I use the 2,000, which one is separated,
You use the what?
2,000 units.
Uh-huh.
And,
What 2,000? 12,000?
and 12,000.
Okay. You use the 12,000. Uh-huh.
12,000 and 800, 980 units. I don't know if,
Okay, first the budgeted fixed overhead was 12,000. That's what we're acknowledging, right? And what else do we add? I mean subtract. Anytime you do budgeted overhead, you must also do what? Applied. So fixed overhead applied was how much? You just said it. No.
900.
9,800. So subtract that from the 12,000, and that's going to give us a volume variance of what? 2,200. Favorable or unfavorable?
It's favorable.
Favorable. All right.
That's it?
Huh? That's it for that one. Okay. This is what I want you to do. You have all of 20 minutes left. I need you to get in your groups right now. Discuss who's gonna do what. I don't care how you do it, what you do, when you do it. I don't care. I just want you to talk, get everybody's information so that you don't have an issue with contacting people. And try to work it out. Man, who needs a printout of it?
Me.
Here you go.
I need to,
Okay, I'll print you out. Okay.
Mr. Jones.
No, I thought you said.
Can we get a print out, please?
Yes, that's what.
Yeah, I'm printing it out now. You know me?
Thank you. You didn't get the call? You haven't got the car yet?
Come in, whoever that is, come in, baby, come in. It's okay.